In this backdrop, the MPC was of the view that persistence of high inflation necessitates further calibrated withdrawal of monetary accommodation to restrain broadening of price pressures, anchor inflation expectations, and contain the second round effects. This action will support the medium-term growth prospects of our economy. Accordingly, the MPC decided to increase the policy repo rate by 50 basis points to 5.9% and to remain focused on withdrawal of accommodation while supporting growth. Now, let me step back a little and elaborate on our monetary policy stance. Monetary policy had moved from neutral to accommodative stance in June 2019. At that time, repo rate was 5.75%. Headline CPI inflation was hovering around 3% and was expected to be in the range of 3.4 to 3.7% in the second half of 1920, and liquidity was in deficit mode with an average daily injection of 0.3 lakh crore in May 2009 under the Liquidity Adjustment Facility, that is LAF. Today, inflation is hovering around 7%, and we expect it to remain elevated at around 6% in the second half of this year. Liquidity remains surplus with average daily net absorption of rupees 1.1 lakh crore under the LAF in September 2022, and this is up to 28th September. As government expenditure picks up on the back of high GST and direct tax collections, the system liquidity will go up further. Thus, even as the nominal policy repo rate has been raised by 190 basis points so far, including the increase that we have effected today, the policy rate adjusted for inflation trails the 2019 level. The overall monetary and liquidity conditions, therefore, still remain accommodative, and hence the MPC decided to remain focused on withdrawal of accommodation. I would now like to provide our assessment of growth and inflation, and first let me take up growth. Real GDP grew by 13.5% year-on-year in the first quarter of this year, this financial year, that is 2022-23. Now, this surpassed the pre-pandemic level by 3.8%. This was led by robust growth in private consumption and investment demand. High-frequency data for the second quarter indicate that economic activity remains resilient. Private consumption has been holding up. There is sustained revival in urban demand, which should get a further impetus from the unfettered celebration of upcoming festivals after 2.5 years of living with the COVID-19 pandemic. Rural demand is also gaining gradually. Investment demand is picking up and is evident from the robust growth of domestic